Good afternoon, everyone. If you please find your seat. Finance Committee is called to order. Good afternoon. Let me ask Mr. Johnson, are there any members of the public wishing to speak?
Yes, sir. Murray Bowden is here to speak.
What else is new? Afternoon. At the Long Island Committee meeting this morning, at the Metro North Committee meeting, there was a discussion of the lights at railroad crossings. And there were all kinds of information and misinformation, and the question as to why red flashing lights, red, are used was never answered. Atlanta, Denver, Boston, Jersey City all have light rail lines. New York City used to have trolley lines, light rail, all controlled by traffic lights. For years and years and years, we've had railroads, because they're called light rail, because the cars don't weigh as much as heavy rail cars do, whatever that means, controlled by traffic lights. So why in this day and age aren't all railroad crossings controlled by traffic lights? And if anybody thinks that any driver knows that a flashing red light at a railroad crossing is different than a flashing red light at an intersection of two streets in a city, and one you can pass and one you can't pass, that's a little bit too much to ask of a driver today. So unless, well, my name is Murray Bowden. I was born in Yonkers, New York on June 11, 1933, and I put that into the record because it's searchable today. Somebody's going to search the record and say, were you notified that you are permitting an unsafe condition to continue? And in fact, you will save money, you will save lives, you'll reduce road rage, but nobody answers the question, why do you continue to use red lights? In East Hampton at the lumber yard, right in front of you are both sets of lights. Why? Because we've been doing it for 100 years. Well, I've now officially notified you on the searchable record that there is no legal reason to continue to use the red flashing lights, and in fact, they're confusing to drivers and there are accidents happening because of it. Answer the question yourselves. It is your responsibility, because you're responsible for the finances of the MTA, why you continue to use flashing red lights instead of traffic lights, and what happens when you get sued because of it. Thank you.
Since there are no other members of the public who are registered to speak, next is the approval of minutes. May I have a motion? Second. Are there any questions or comments on the minutes? Hearing none. All in favor of accepting the minutes? They are approved. Mr. Johnson, could you take us to the work plan?
We have no changes to the work plan today. And the next item is Budget Watch. So this month's Budget Watch will focus on April operating results and subsidy results through May. I'm going to start with passenger revenues. For the month of April, they were $13.1 million below budget, which increased the unfavorable year-to-date variance to $36 million. A lot of that has to do with lower New York City Transit fare box revenue, some of that being from winter weather impacts, but we've also seen just a lower ridership than the budgeted growth that we had projected. Toll revenue, on the other hand, which Don talked about at the last meeting, continues to perform well. Positive results in April increased the year-to-date variance to $24.5 million. So that $24.5 million offsets about two-thirds of the $36 million unfavorable passenger revenue through April. Expenses in April were $61.2 million, or 7.1% favorable. That increased the year-to-date variance to $151.5 million, which is 4.3%. Some of that are real savings from lower costs for labor, fringe, and energy. We also have some timing delays with some contractual services and materials. Within the expense category, we like to look carefully at overtime. Preliminary overtime expenses for the month were $3.9 million, or 7.2% favorable to budget, which was good news. New York City Transit and Metro North had favorable results largely due to lower weather-related overtime requirements. Monthly variances for the other agencies were minor. The year-to-date variance mainly is still modestly unfavorable, and that reflects higher track work-related overtime at the Long Island Railroad, and it still has the higher Jonas-related New York City Transit overtime that was experienced in January and February. Debt service costs continue to run favorably due to lower rates and the issuance of less debt. Moving on to subsidies, with the exception of the payroll mobility tax, if you look at basically all of the other subsidy sources that we have, they're running just at about budget. PMT collections were unfavorable in May, however, by $55 million, or 35%. We had been running favorably year-to-date, so now with the unfavorable added to that prior favorable, we're running about $35 million unfavorable through May. We're trying to investigate what's going on with that, whether it's a timing variance, whether it's an actual shortage. It could be just the way we calendarize from month to month. It's a little bit tricky. Yes, sir, Mr. Murba.
I have a quick question.
Sure.
On the first page of the Budget Watch,
Okay.
we do not have a comparison year over year. Is that possible? Is it feasible? So, for example, the adopted budget in this year for subways expects a revenue of $1,115,000, or $1,115,000,000. What was it last year?
Well, it's funny, Bob and I spoke about that. We were just at about at last year's level, and we had projected the budget and expected an increase based on economic and other growth. There's a slight reduction in the month of April, in part because you probably don't remember, but we had a significant amount of rain on the weekends on the transit side, which that'll impact the discretionary ridership. So we're basically flat to last year, maybe slightly lower, as opposed to a budget which assumed a growth assumption.
How does that square with the fact that the ridership has significantly increased year over year?
Well, it's increased year over year, but in the first 4 months of this year, we haven't seen that from the numbers that I've looked at. Transit right now is developing a reforecast of their ridership and revenue in preparation of the July financial plan. They're looking very closely at these numbers as we speak.
And are they taking a look at potential reasons for why this is not materialized?
They are.
And are they doing the same for the other facilities? Long Island Railroad, Metro?
Yeah, they all do that. There doesn't seem to be quite as much a story there. You know, the two stories right now is the toll revenue is very favorable. Subway ridership, not so much. The Long Island and Metro North, it's much closer to budget, but they each have staff that are expert in doing that analysis. Yeah, which we'll report on that in the July plan. That's part of the mid-year forecast. And these numbers will impact the forecast going forward as well.
Mr. Albert, I'm sorry. Are you done?
Just to say, so, I gave you lots of ups and lots of downs. If we were to sort of try to summarize and characterize the results, overall, we are somewhat favorable year to date. Like I said, the toll revenue's up, expenses are up, debt service expenses are favorable, I should say. Debt service is favorable. And the two downsides are the payroll mobility tax. We're not sure if that's a real downside, and the passenger revenue. Yes, sir.
And then Mr. Zuckerman.
Doug,
Oh, sorry.
who will you be asking about the PMT? Will it be the Department of Finance of the state, or?
We talked to DOB and the Department of Finance. DOB is our direct contact, but direct
Budget.
finance does a lot of the forecasting work, which is very analytical, very detailed. Again, we've been up and down on that every month. If it was unfavorable, then we swung to favorable.
Is it possible that some counties are not
It's
reporting
possible,
accurately, or?
but, part of it could be on us. We focus on the annual numbers, and then we have to try to calendarize it, and we try to look at trends,
Yeah.
but they're not all, it doesn't always fit into the cookie cutter categories. It's not necessarily the exact same cycle every year. We're more focused on, obviously, the amount that we get in aggregate.
Thank you.
Yeah. Hi, Neil.
This is more of an education question for me,
Sure.
or
Okay.
at least a reminder. What drives the PMT? It is a percentage of what?
Primarily, it's payroll. So it's really-
payrolls.
Yeah.
It's tied to, so it's drivers' employment levels.
It's the employment and salary levels
it's-
in the MTA region.
And given the way the direction of wages are going, it shouldn't be going minus. It should, right?
Yeah,
So,
that's right. I mean,
interesting.
you also have self-employed people that may not pay on the same cycles that a larger employer would. So these are the variables that impact, the fluctuation. Okay, Paula Serra is here to take us through Finance Watch.
Thank you, Doug. Finance Watch is on page 18 of the committee materials, if you have the books. We have 3 transactions to report this month. On May 9th, MTA tendered and remarketed a $50 million MTA Transportation Revenue Series 2012 A2 floating rate note. The notes were remarketed on a competitive basis, with Jeffries LLC providing the winning bid. These notes will remain in the floating rate mode through June of 2019 and will pay a floating rate of SIFMA plus 58 basis points. Aura Carrington and Bryant Rubino served as co-bond counsel on the transaction, and PFM served as the financial advisor. Next, skipping to the bottom of the page, if you're following along, we have a summary of our monthly fuel hedge. This was bid on April 28th. 2,900,000 gallons of ULSD was hedged with Macquarie Group at an all-in price of $1.55. Additional bidders on that transaction were J. Aaron and J.P. Morgan. With regard to the transaction that is referenced in the middle of the page, last week on the 18th and 19th, we issued 588 million dedicated tax fund green bonds to pay off outstanding 2015 DTF bans that were issued last year, and also to refund 192 million 2009A and 2009B bonds. The refunding portion resulted in approximately $39 million in present value savings, which was nearly 21% of the refunded bonds. The transaction was lead managed by Bank of America Merrill Lynch, with MBE firm Loop Capital Markets, MWBE joint venture Siebert Brantford Shank and Morgan Stanley, and service disabled veteran-owned firm Drexel Hamilton serving as co-senior managers on the transaction. Nixon Peabody and D. Seaton and Associates served as bond counsel, co-bond counsel, and PFM served as the financial advisor. One last thing to report, the MTA has completed this year's annual combined continuing disclosure filing. That is in compliance with our municipal bond disclosure requirements. The disclosure document was filed with Emma online, and a copy is available on the MTA website. And we'd like to thank everybody who was involved with completing that filing.
Well, a couple of questions. What was the percentage savings on the deal you did last week?
21.
That's an extraordinary percentage for those who don't follow those things. That's terrific. Thank you. And when does it close?
This Thursday.
Oh, good luck. I think that reinforces the point that I'd like to emphasize, and I hope you're active in it. I hope not to ruin your late spring, early summer, but the bond market is in totally unanticipated and possibly record performance levels with low interest rates, at least in great territory for an issuer. And I hope we're pursuing as many refundings as possible. I'm sorry, but the staff might have to get tired. But you got lots of bankers and lawyers on your many, many firm team, and I hope we're taking advantage of it because
We
a lot of
absolutely
people are.
Yes, we absolutely are. We review refunding candidates every day, basically. And anytime we're in the market, we will add refundings to our transactions, or we will, if we're not in the market, pursue any refundings that make sense.
Well, I look forward to an even longer finance watch next month because I really hope you spring a few surprises to take advantage of these rates. And my last question, I appreciate your help. What is the status of the investment banking RFP process that I understand is underway?
We're currently reviewing proposals. It is our expectation to make a recommendation to the board in September, the September board meeting. And then we would follow on thereafter with recommendations for financial advisors. That RFP is not yet out on the street.
When do you anticipate that RFP being issued?
I think we're starting to work on it in the next month or so, and hopefully out by September.
Anyone else?
I'm sorry, that's it.
Finance Watch? Oh, thanks. Moving next to headquarter and all agency items. We have two report and information items. The first is to advise the board of the station maintenance billings for the period April 1st, 2015 to March 31st, 2016. That report is detailed on pages 28 to 32. For your information, we are billing a total of $162.2 million for the year, which is a $1 million increase over last year. Are there any questions on that? Okay. The second item is a draft of the annual pension fund report as of December 31st, 2015. That's detailed on pages 33 to 51, and Sean Crawford, our Chief Investment Officer, is here to present that report. He's with Maggie Connor.
Good afternoon. I'll try to walk through this presentation rather quickly and answer any questions as they come up. Oh, of course. If we could start on slide 2, the overview of the retirement programs, both those are sponsored by the MTA and those that are external. I think this highlights the enormity of the task that we're facing. I'm sorry, me. Of course, I think I went the wrong way. There we go. So this highlights the enormity and complexity of our pension obligations, our pension systems. The first bucket are the defined benefit programs that we have sponsored and oversee with $6 billion in assets. The next bucket are the defined contribution plans, and then another $4.8 billion in assets. So again, highlights the enormity of the task and the responsibility we all face in overseeing these investments. We could skip forward to the next slide, just a quick market overview. 2015 was a pretty challenging year. The S&P 500 was up, bonds were up in the U.S., but everything else was basically down. Commodities, emerging market equities, developed market equities. So it was a really, from an academic perspective, it was an interesting year. From a investment perspective, it was an interesting year. A lot of things going on, but it was challenging to generate meaningful performance kind of across the board. The expectations going forward is that we continue to be in a low rate, low return environment, and that is going to challenge us going forward in producing results that meet our returns expectations. This is an overview of the asset allocation for the defined benefit plans and for OPEB. This is something that we are constantly revisiting and reviewing to make sure that going forward we have the best capital allocation policy in place. We're constantly taking advantage of what the markets may be giving us and constantly looking for ways to reduce risk across the portfolio. This is the big picture snapshot of how we're allocated today. And I think, as you could see, we're diversified across all the major asset classes we're diversified within the asset classes. And I think it's a really reasonable and responsible asset allocation policy that's been developed over the years with our external consultant, NEPC, for the defined benefit plans and for OPEB. So this is where the rubber hits the road. This is the performance for the retirement plans over the last 1, 3, and 5 years. As you could see, in the 1-year period, there were a lot of asset classes that lost a lot of money, whether it was commodities or emerging markets. The outliers in performance were in the liquid buckets, so real estate and private equity. We're allocated across all of these, and in 2015, our plans were down between 1.2 and 1.8% net of fees. So a very challenging year. I think going forward, what we need to keep our eye on is continually reduce risk within our plans, keep our diversification targets in place, tilt towards quality, and tilt towards investments that kick off cash flow. And in the context of our historical performance, again, versus a generic blend of 60-40 U.S. equities, fixed income, and the peer group medians, we consistently take a lot less risk in our asset allocation and in our performance versus both. And I think the conservative nature of our plans and the performance of that has really borne out in the months in the past year where we've seen down markets and we've actually held in relatively well. So I won't go through every slide, like I said, but I do want to highlight this is our return assumption. Our return assumption is 7%. That puts us in the same company as the city and a little bit less than the state of New York. These are the 7% return assumption is a pretty conservative assumption within the public plan space. As of the end of 2015, the median assumption was 7.68%. So we're running it a little bit more conservative than what the peer group really is. Which means at the end of the day, we have to take less risk to get to our return target. And the funding update, this is where the plans stand in terms of funded ratio. MTA DB is at 73%, MAB-STOA is at 70%, and the Long Island Railroad is at 49%. Dramatic improvement in the funding status of the Long Island Railroad as contributions have been made over the past few years. Then we'll skip through the next few slides. These are the investment managers that we have in all of the plans. DB, MAB-STOA, OPEB, and DC. And I will conclude with an overview of where we stand in MWBE participation. MTA DB total AUM, if looking at the total plan, 9% is allocated to MWBE, MAB-STOA about 15%. If we look at only traditional asset classes, so equities, U.S., international emerging, and fixed income asset classes, we're standing at 20% in the DB MWB participation and 34.6% in MAB-STOA participation. This, if put this into context, the MWBE participation the composition of the investment universe, less than 5% of investment managers classify as MWBEs. If you look at number of strategies in the market, it's less than 4%. So in the context of the opportunity set, I think we're doing well, but there's always obvious room for improvement across the board. So with that, I'm concluding my remarks and happy to answer any questions. Yes.
Could you remind me, please, how the investment managers are compensated?
The investment managers are compensated on a traditional fee arrangement, so percentage of assets managed. So there are no other fees other than the basis point charges per manager per year.
So that's on the aggregate they're investing?
For us, yes.
For us?
For us, yes.
And is there a, so as the amount they invest go up, they make more money irrespective of the returns on those investments?
Assuming that the account is also growing as well, right? So while we're contributing, it's a component of both our contributions and the performance on the account. So if they have $100 with us today and it grows by 10%, we don't add any money to it, so now it's $110. Their fee is based on $110, right? So as the accounts grow in value, our fees go up in terms of dollar amount, but we also have in many places sliding fee schedules. So as the amounts go up, our fees actually come down. so that we get the benefit of size and for scale.
Based upon their performance, it's just based on the size.
It could be based on the size and could be based on performance. So if we have, an example would be a manager that has certain fee breakpoints. So say it's at 25 million, 50 million, 100 million. As you cross those thresholds, the fees start to come down. The percentage rate would come down. Yeah. And fees is something we spend an awful lot of time looking at.
What is the effect of the funding status? The slide you showed of the three different groups and how much they're funded. What is the relationship between that and everything else, if any?
So that funding status would reflect both the contributions coming in, right?
Right.
So as the contributions are made according to our annual target numbers, the big number would be, the big thing would be the slide in front of it, that's 7%. So this return rate assumption, if I go back to this,
Right.
that funding ratio is tied directly to this return assumption. So as you would increase your return assumption, your funding ratio would increase as well. If you decrease your return assumption, your funding ratio decreases.
And that's because,
It's because of this would be the amount that you're discounting the future liabilities at. So there's a benefit to having a much higher discount rate versus if you're looking at funded ratios.
discount rate meaning the difference between 100% and the amount you're funded?
The discount rate in this case would be 7%.
Right.
Right? So if you moved it up to 8%, your funding ratio would actually increase because you're discounting your future liabilities at a much higher rate.
Okay. Because the controller sends me all kinds of stuff as a retiree, telling me he's at 7.5, and telling me why he's at 7.5. Notwithstanding all of that, you don't want to be at 7.5.
I think I can't comment on.
I understand.
What they're doing, but
But there is a difference, obviously.
There is difference, and in my view. So this is determined, ours is determined by the actuary, and so there's a reasonable basis for that, but what it comes down to is, if you look at the world today, and you look at long bond yields at 2 and change, and you look at an S&P 500 of maybe you're going to get up into the mid-single digits in terms of return. If you look at annual risk premiums, 7% is going to be really hard to get to.
Right.
In a way, right? So anything above that, you start to really have to kind of stretch.
Yeah. Sean, let me jump in here. We are actually considering recommending, a lower rate. There's a lot of people out looking at public pension funds who believe that we've been using too high of a rate for too long. And the recommendations are that you look at something that's more like a risk-free rate. So perhaps a long treasury rate, or if you're a general obligation bond issuer, general obligation bond rate. That's too far of a stretch, I think, right now. But again, we want to have a very solid, conservative, well-funded pension plan. And I think one of the ways you get there is you start putting more money in the plan. And one of the ways that you put more money in the plan is you have lower assumptions rates, and that just forces you to do it.
That forces you to make a larger contribution because you're not making it up on the investment.
That's right.
Even I can figure that out.
Yeah.
Even I can figure that out, right.
The other thing is this gap that we have. We are reducing that gap every year.
Right.
So the unfunded portion of our pension plan, we are making contributions every year to reduce that unfunded portion, all things being the same. So again, we're on track. We're doing the fiscally responsible thing. We're not required anymore to do the actuarial required contribution, which would get you there, but that's what we're actually doing. We continue to fund that. Plus, as you know, on the additional Long Island Railroad pension plan, we're making additional contributions.
And that is of benefit not only to us making the additional contribution, it is of benefit to the retirees or prospective retirees, depending upon your point of view at the moment.
It's more certain the money will be there when it's needed.
Okay.
Thank you.
Mr. Zuckerman and Mr. Ballard.
Thank you, sir. One of the topics, I'm not an investment professional, but as you read the popular press in the last year, 18 months, you read about entities like CalPERS pushing back heavily on hedge funds and private equity firms and their fee structure, and picking up a theme of Mr. Ballin's. And if you look at page 9, we do see a fair number of hedge funds and private equity funds listed. So my question is, again, picking up on Mr. Ballin's theme, I don't see in here some sense of our aggregate expense for the various managers we have, and we have many, many strategies we're employing, from straight equity to private equity and the like. So it would be interesting to know how both what our absolute, and you may not have this data now, and that's fine, what the absolute fee structure we're paying, not structure, but fees we're paying, but more importantly, how does that compare to peer funds in the marketplace that we would be akin to in size and scope and style, to understand what we're paying relative to those entities, and is that competitive?
Yeah, I think that's a great question. It's something that the data on the peer group is really hard to get to, because nobody wants to disclose what their fees are, to be honest with you on that. So maybe if I could take like the broader question about hedge funds and private equity, I think, I join those that are skeptics of those asset classes. I think they have, in a broad generalization, failed to deliver for a lot of investors over the last 5 years. We've actually got in our plans great results out of what we have. So I think if you look at what CalPERS or the city has done, they might have a different experience with those investments. And I think what it comes down to is everything in the plans has a very specific role. There isn't, I wouldn't call it a hedge fund program or a private equity program. Everything needs to have a place in a home, and then to diversify a specific risk that we have within the traditional asset classes. And then the reality on the privates is that we're never going to get towards our 7% without private equity. I think that's a big part of it. But as we peel back and think about the fees and about what we do there, one of my opening comments was we're in a low return environment. And I have really little interest in giving away half of our return in fees, right? That's the reality that we're facing. And we've actually redeemed from some of our hedge funds over the last, call it 6 to 8 months. And if we redeploy, it'll be at much better fee terms. So we're looking to bring those fee costs down across the board. We're revisiting every manager that we have money with and saying, we've been with you for 5 years, 10 years, 20 years. It's time that you give us a break on fees. So that's something that is, in a low return environment, that's the one thing you could actually work on, right? That's the one thing that you could actually do to boost performance is to get your fees cut.
Thank you, Mr. Chairman. Thank you, Neil. I don't want to belabor this too much because I know there's a heavy agenda, and this is fascinating. But there are an extraordinary large number of investment managers. They all presumably are working hard, very bright people doing things that, I know I couldn't do. But the one check that we do have is through a process to make sure that they want to really keep the business. So could you give a brief overview of how these people are evaluated and replaced, what the RFP system is like? And then I want to have just one final comment before you do that. I know when I do work for public agencies as a municipal bond attorney, we have, unfortunately for me, but good for the public, we have lower fees for public entities than we do for private entities. And we have a similar concept baked into this. So if you can answer all those. And I don't mean to start a long, extensive discussion, but there's overview, please.
No, these are all important questions, I think. So in terms of manager selection, everything goes through whether it's NEPC for our defined benefit plans or through Mercer for a defined contribution plan. So they're tasked with the due diligence, fund selection, and the initial idea concept. And then once it's really hard to separate the manager selection from the asset allocation. These are things that kind of go hand in hand, and that when there's a reason to change, and we've actually changed quite a bit over the past few months, in terms of the managers that we have within a portfolio. It's a very deliberative process with our consultant who brings the ideas to our investment committee, and we vet them, we interview them. These are firms that have to meet a variety of qualitative and quantitative criteria in order to be selected. One of the things that we struggle with is really on fees, because a lot of these managers that we are looking to invest with, they're capacity constrained. So they can only manage a certain dollar amount, and they're unwilling to go above that certain dollar amount. So unless you're in a passive equity type of strategy, the pressure on fees, we want to pay as little as possible. The investment manager wants to make as much as possible. When it's a capacity constrained strategy, the ability to wiggle those fees down a bit becomes more and more challenging. So we have more success in large cap than we do in small cap. We have more success in developed markets versus emerging markets. We have more success in U.S. fixed income than emerging markets fixed income. So it becomes an asset class by asset class conversation in a way. Is that helpful?
Yeah, it's the start. I think we'll continue it over time. But and the notion of discounted rates for government?
Some managers do that. It depends. There are so many factors that go into the fee conversation, but it also depends too as if they really want our business. And I prefer to work with firms that really want us as a client, that will respect us as a client, versus taking an off-the-shelf fee that's available to everybody else.
There are a lot of factors. Their capacity constraint versus the amount of money we have per class. And
That's right.
you could go on and on. I see, but that's very helpful. Thank you.
Including your report?
That is the conclusion of the report.
Okay, good. Are we ready to go to procurements? And Mr. Barbosa.
Thank you. So for headquarters, there are 4 competitive procurements for a grand total of $71 million. I'll speak to a little more granularity into 3 of those procurements. The first, we're looking for approval for a contract award for all MTA office supplies in the amount of $21.7 million. Very competitive RFP process. 107 firms requested the RFP package. 14 of those firms were M&Ws. We received 10 proposals. The final award is to Staples. The baseline projected spend for office supplies for the MTA over a 5-year period is actually $24 million. Based on further analysis and negotiations and SKU rationalizations, we lowered that projected baseline spend to $19.7 million. So that's a reduction, an actual reduction over 5 years of approximately $4.2 million or 18%. The next procurement I'd like to speak to is all MTA IT hardware servers and computer maintenance services. Again, a very competitive RFP. 83 firms requested the RFP package. 31 of those were M&Ws and disadvantaged firms. We received 12 proposals. We shortlisted actually to 5 firms. We're awarding 3 contracts to Dell for desktops, laptops, monitors, and thin client devices, CDW for various servers and rugged laptops, NPA for computer maintenance services. The 5-year projected baseline spend on IT hardware for the MTA for all agencies was $69 million. Based on this RFP process and unit cost reductions for hardware and for services, that baseline spend now is $31.6 million. That's a reduction of $37.4 million, which is about 54%. The last procurement I'd like to highlight is the All MTA Managed Print Services Award. Again, a very competitive RFP. 85 firms requested the RFP package. 39 of those firms were M&Ws. We received 6 proposals, shortlisted to 4 firms, ended up going with trying to award to HP. The baseline spend, projected spend for the agencies was $24 million. So that was for 5 years. Based on the RFP and reductions and analysis, the baseline projected spend is now $15.4 million. That's a reduction of $9.2 million or about 37%. So overall, these were very competitive, very fruitful RFPs. I'd be remiss to say that not talk about at a very high level. We partnered with KPMG on these three RFPs, so they were very, very well run, and we ended up with a mass amount of savings for ourselves. Any, Vice Chairman?
Quarters, procurements, may I have a motion and second? Are there any questions or comments? Hearing none, all in favor? Procurements are approved. Next is MNR procurements.
Yes, there are 4 procurements for Metro North for a grand total of $14.1 million. One is a non-competitive sole source procurement for a total of $664,000, and 3 are competitive procurements. 2 of those are for RFP, requests for RFP processes, and 1 is for a modification for additional funding for a total of $13.4 million. Chairman?
May I have a motion and second? Questions or comments? Hearing none, all in favor? Opposed, abstentions, the procurements carry. Long Island Railroad procurements.
For Long Island Railroad, there are 4 procurements with a grand total of $56.8 million. 1 is a non-competitive sole source procurement for a total of $160,000, and 3 are competitive procurements requesting to use the RFP process for a total of $56.6 million. Vice Chairman?
Is there a motion, second? Any questions or comments? Hearing none, all in favor? Opposed, abstentions, those procurements carry. Transit and bus?
Yes. For New York City Transit and MTA bus operations, there are 3 procurements with for a grand total of $32.1 million. 1 is a non-competitive procurement for miscellaneous services for a total of $578,000, and 2 are competitive procurements. 1 is multi-agency for contract modifications for a total of $31.5 million.
Motion and second? Questions or comments? Hearing none, all in favor? Opposed, abstentions, those procurements carry. Finally, bridges and tunnels procurements.
There are 2 competitive procurements requesting to use the RFP process for B&T for a grand total of $255 million. 1 is a modification to amend a personal service contract for additional funding. Vice Chairman?
Second? Questions or comments? Hearing none, all in favor? Opposed, abstentions, those procurements carry.
That concludes procurements.
Thank you.
Thank you.
Okay, next is First Mutual Transportation Assurance Company. This is the month where they do their annual presentation to the board. Information is on page 82. I'd also like to note that their financial statements, actuarial loss reserve certification, and investment performance report are on director's desk and can be found on the MTA website, mta.info. Phyllis is here to describe this. Yep.
Excuse me, I'm Phyllis Rockman. We're here today for our annual report to the Finance Committee. The information was made available to you already on the web, and it included the audited financial statements and the opinion and determination of the actuary that the reserves held by FIMTech are adequate and meet New York State captive requirements. I'll update you on the major insurance programs, and then Sean Saya from Goldman will report on the investments. The All-Agency Excess Liability Program renewed October 31st, 2015. The program provides third-party liability coverage excess of the agency's self-insured retentions. FIMTech insures the first $50 million layer of the excess of the retention, and we procure an additional $350 million through the commercial marketplace. The $350 million layer renewed at expiring terms and conditions with a slight increase of 2%. The All-Agency Property and Terrorism Programs renewed May 1, 2016. The terrorism program was renewed with an 11% premium reduction for a 2-year period from May 1, 2016 to May 1, 2018. During this renewal, it was noted that incumbent insurers were limited in the amount of total capacity available in the metropolitan area, so the two-year program allows FIMTAC to protect itself from potential future capacity shortfalls. As far as the property program, this year we increased the overall program limit from $600 million to $800 million. This includes an increase in limits of all risk and catastrophe coverage of flood, wind, and earthquake. The program now mirrors the CAT limits that were purchased prior to Superstorm Sandy on an indemnity basis. MetroCat continues to supplement the coverage for an additional $200 million in storm surge coverage, and that capacity is in place until the end of July. We now have the opportunity to eliminate the cost associated with renewing MetroCat. In addition, we received an overall savings of 18% on the property placement. The property program structure and additional limits were achieved as a result of a combination of factors, including a softening property insurance market, increased competition between property markets that have come back since Sandy, and new insurance markets interested in participating on our program. The insurance market has also evolved over the past few years with new products offered from insurance-linked securities market that are competing with traditional insurers as well as with cat bonds. This has led to significant capacity in the insurance marketplace while driving prices, terms, and conditions more competitively. These are the investment accounts and their values as of March 31st. Each account services specific FIMTAC-insured programs. The excess loss fund and the discovery accounts have very specific mandates, while the general operating account covers multiple programs and their specific claims, losses, and expenses. Now I'll turn it over to Sean Sayer from Goldman for an update.
So good afternoon. Thank you for having me. I have my chance to be here with you effectively once a year. And so what I like to do is kind of just, we're looking at results for the last 12 months, effectively ending March 31st. As Sean mentioned, Crawford, in his remarks on the pension side, we've been in a relatively low-rate environment, and that's absolutely the case as it relates to the investment opportunities for FEMTAC's portfolio. We manage about $400 million in market value of assets for FEMTAC, and it's about 95% invested in fixed income. So really we're specifically focused on opportunities within treasuries, corporate bonds, mortgage bonds, asset backs, and so on. One thing I like to do, if you turn to the first page in the presentation, is just a quick snapshot of kind of what happened in fixed income markets, particularly during the last 12 months. And I think if you just look at the graph on the right-hand side of this chart, what you'll notice we have two sets of bars. The blue bars kind of representing the total return, if you will, for each of those different fixed income sectors during the last 12 months. And you see that most of them were positive. So treasuries gave you about 2.4%. Corporates, depending on which industrials, utilities, and so on, but somewhere between 0.4 and 1.8%. But then when you take a look at the red bars, you see that most everything kind of is on the left-hand side, and that represents the excess return. So if you were to take the return of each of one of those risk assets, we consider them, and subtract from that the performance of treasuries, so kind of take out the risk-free rate, how did they do? And you can see that in most cases, most risk sectors, if you will, had negative excess returns over the last 12 months. And really that's a function the primary cause of that is that over that last 12 months, you've seen investors in the markets kind of move away from risk assets, so move away from corporates and move away from mortgages and invest in treasuries. And that's one of the reasons why treasuries had the best performance over that last 12 months. So when we're thinking about that, what we happen to see is the spreads have increased. So that's a spread is a measure of how much risk your investor is willing to take in, let's say, a corporate bond versus a treasury. And the spreads have widened, which means that kind of that risk requirement has increased. And as such, we've seen kind of negative performance versus treasuries. If you turn to the next page, we have, again, a snapshot of performance for the entire FEMTAC portfolio. I think if you look at the table on the right-hand side, looking down toward the trailing, the last 1 month, or last 1 year results. So the portfolio returned about 1.7%, and the benchmark about 1.6%. So modest outperformance, but effectively in line with the benchmark. And really, when we look at what worked, what was the attribution associated with that performance across, we are running kind of different strategies for the different mandates. But when you aggregate it together, really our positioning with respect to interest rates, so how much maturity and duration risk we want to take, actually was a bit of a drag. So we actually had a little bit, we were underweight how much average maturity we had versus our benchmark, and that actually hurt us a bit because yields continued to come down over the last 12 months in aggregate. But what did help the performance was the selection that we had within both corporates and mortgages. So the bonds that we bought and the bonds we held did well versus the bonds that are held in the benchmark. So our selection process proved to provide the most of that positive performance. And the last slide I'll take you to here is just give you a snapshot of how we're currently positioned in the entire portfolio and let you know kind of what our outlook is as we move forward. So if you take a look at the bar charts on the left-hand side, the light blue happens to be where we were positioned a year ago, March of 15. The dark blue, where we are positioned today. And I think the largest changes that you can see is that we increased our government exposure. So that, again, is a function of what was happening to rates and our outlook on Treasury rates. And we reduced our exposure to corporates. And that is in line with a couple of rationales. One, corporate bonds we've seen their spreads, their risk associated versus treasuries have actually done quite well over the last couple of months. So we think they've run quite a ways in the last, let's say 2 months. And we're also entering a season, typically from now until August, where it's relatively slow. It's actually a poor period of time for risk assets like corporates. So we're starting to pare back some of our exposure in corporates and mortgages, and starting to put some of that exposure back into treasuries. And so that's one of the changes you've seen over the last 12 months. Other than that, there were no real material changes in the strategy other than wanting to kind of reduce risk in the corporate sector. And if you take a look at the snapshot, the chart on the upper left-hand side, I know the number's a bit hard to see on the board, but what you can see is when you look at how's our positioning versus the portfolio, we were overweight to commercial mortgages, we were overweight to corporates, and we're underweight to residential mortgages. And that's a theme that we're likely going to kind of maintain throughout the next couple of months. We think it's prudent to not take too much exposure in residential mortgages. We think it's imprudent to have some exposure to corporates. As I mentioned, we're starting to reduce that a bit, just in anticipation of the soft environment we're going to come into in the summertime. And if you look at the very bottom on the portfolio stats, so the portfolio is comparable to the benchmark from its ratings. It's about 1 notch lower in its ratings quality versus the benchmark. Our current duration or average maturity is also a little bit less than that of the benchmark. Again, positioning ourselves for what we anticipate is going to be some Fed movement in the second half of this year. And we've got both a yield and a spread advantage built into our portfolio versus the benchmark. And so we hope that will kind of cushion us to the extent we do see rates start to rise in the second half. And that concludes my remarks.
Thank you. Any questions or comments? Then we're ready to go to Jeff Rosen and the real estate report.
Thanks, Freddie. We have 5 action items this month for your consideration and approval, each the subject of a staff summary. I hope the staff summaries are self-explanatory. I'd be glad, of course, to take any questions.
Questions or comments?
Just a quick question. I saw in exchange for getting out of the lease early, there's the payment for building a new station entrance.
Yes.
we have a number in there that if we did it would be $14 million. Do we know how much they're estimating it's going to cost?
I don't have that information. I think it's fair to say that it would be less. I think we need to look at it from both sides, and from our side, we think it's worth that much.
That was my only question. $14 million is a big buyout.
Thank you. We need a vote.
Motion, second? Second. No other questions or comments? All in favor? Opposed? Abstentions? Motion carries. Second.